Hey, everybody, and welcome back to the Teaching Tax Flow podcast, episode 160 today. We are diving directly into the IRS Schedule 1A. That's right, a new form for you to know about and complete in its entirety, or as much as you can. So before we get into this one, as always, let's take a brief moment and thank our episode sponsor.
This episode is sponsored by Wealth Builders Mortgage Group, powered by Movement Mortgage, one of the top mortgage teams in the nation and a powerhouse in the real estate investing world. With over $1.1 billion in closed mortgage volume and more than 3,000 investor deals under their belt, they don't just talk the talk, they walk it. Their team specializes in helping short-term and long-term rental investors scale smart with customized lending strategies. They offer all STR loan products, including second home, investment, non-QM, bank statement, asset-based, and HELOCs. They also offer all primary home loan products too. Whether you're just starting out or expanding an existing portfolio, their unique Path of 10 strategy is designed to help you move from a 9-to-5 job to financial independence. If you're looking for a lending partner who truly understands the investor mindset, visit wealthbuildersmortgagegroup.com and start building your roadmap today.
All right, everybody, we are back here again on the Teaching Tax Flow podcast. And of course, we like to come up with things, find things, and deliver them to you in a very simple, understandable manner, which is why we are bringing you, what I mentioned earlier, something new. So we're looking at that Schedule 1A. And again, if you haven't heard about it yet, you're about to. To be honest, I hadn't heard about it until recently. And I heard from this guy who's joining me as always, Chris Picciurro. Welcome, good sir.
Well, it's great to be back, and we are excited to talk about something new here. Remember, legally and ethically reduce the tax you pay in your lifetime is the goal of Teaching Tax Flow. The IRS has its hands full with the One Big Beautiful Bill Act, OB3. We talk about it a lot here on the podcast, talk about it on the Teaching Tax Flow YouTube channel and our Defeating Taxes private Facebook group. But many times, what we don't consider is that whenever there's a change to the tax code, forms have to get updated. And that takes a long time, and then software has to get updated. So we have a lot of new deductions with OB3 that take effect in the 2025 tax filing year. And these are kind of unique deductions. You know, in the tax world, we talk about some deductions being above the line. What that means is that means that you're getting that deduction before we calculate your adjusted gross income. And you don't have to itemize your deductions to get that deduction. And then there's deductions that are called itemized deductions, or what a lot of times we would call below the line. And now we have some deductions that we're calling, I heard another tax professional say, between the lines. It's kind of like coloring between the lines, meaning they're not a deduction that you get before you calculate your adjusted gross income, but they're also not an itemized deduction. So you don't have to. You could take the standard deduction as a taxpayer and still qualify for several new deductions. These new deductions are what make up the Schedule 1A. And just to give it an idea of the magnitude of this, and again, thank you to our members of the Defeating Taxes private Facebook group, because John, we are getting so many comments on our YouTube videos. It's great. Why is it great? Because it tells us what taxpayers are looking for. And out of the about 161 million returns filed for the 2024 tax year, individual returns, it's estimated that about 30 million to 40 million of those returns will include a Schedule 1A for the 2025 tax year. So this is going to affect, I think that number might be a little low. Somewhere between 20 and 40 million taxpayers, most likely. So
It's a big number.
You're in the right place. And we always say, John, ideas are
Cheap.
implementation is valuable. Right? So
we should have done that. Like, we should have found a way to make a jingle out of that where we're singing it so it gets stuck in people's head. And you know what's really good about this too? Here we are talking about this form. I think I started off, and then you had mentioned too, it's completely new. I absolutely love the fact that you explain why these come into place, right? They just don't pull these out of thin air and hey, let's create a form today. This really is the reaction, if we will, of changing something else. So even though this may seem like it's complex or it's adding complexity to something, it's a necessity, needs to be done. And then if anybody's listening to this or watching this, I mean, congratulations, you found this somehow or another, whether you're a subscriber or whatnot, but you're now going to know about a form that you might be able to take to your tax professional next year and see it and know more about it. And, it might be new to them who knows how in tune they are with some stuff. But what a great opportunity, right? And Chris, so we don't have to dive into it, but I am going to put some links in the show notes here, referencing some previous podcasts we've done where we've talked more specific on types of deductions. So that way people can go reference those as well.
Right, you nailed it. And I was going to mention that we have other podcast episodes on some of these topics. We're going to have them all eventually. We have tons of YouTube content on these topics. So what does the Schedule 1A calculate? It's going to calculate additional deductions for taxpayers on your federal tax return. Remember, if you live in a state that has a state income tax or local area that has a local income tax, you have to make sure or check to see if they are in conformity to the federal tax rules. And like I said, ideas are cheap, implementation is valuable. So you might hear, hey, I heard there's an additional deduction for this. I heard that the tips aren't taxable. I heard this, but what are the rules and how does it actually go from an idea to your actual tax return? So Schedule 1A starts with figuring out your magi. Now, if you did all the nerdy things like I did when I was younger, like Dungeons and Dragons and go to MagiQuest. A magi was typically like a magician type person, but magi means a modified adjusted gross income. Typically, that's going to be the same for the majority of taxpayers as your adjusted gross income, or what you might hear is AGI. That number is coming from page 1 of your personal tax return, and that's the starting point of calculating all these additional deductions. So Schedule 1A, it's going to calculate up to 4 additional deductions. The first one's going to be the no tax on tips. So remember, we've talked about that several times. This gets tricky, right? And so I say there is absolutely no easy tax return. Absolutely no easy tax return. We talk about that a lot because most of these deductions have what are called phaseouts. Phaseouts occurs when you start to lose that deduction when you hit a certain income level, and then it gets completely eliminated at a higher income level. Wouldn't it be nice if all the phaseouts were the same? Of course it would be. But guess what? They're not. Every deduction has a different phaseout schedule. And that's why things are so important. And that's why the number one KPI for tax planning is your marginal tax rate, not your tax bracket. Because your marginal tax rate takes into account phaseouts of credits and deductions. So Schedule 1A, the first thing it's calculating is no tax on tips. And those qualified, we talked about in a previous podcast episode, I believe, what qualifies as a tip to be excluded, what industries qualify, et cetera, et cetera. But assuming you have qualified tips, either from self-employment, i.e. our friends driving that Uber, driving the Lyft, driving the DoorDashing and all that jazz. And if you have teenagers, you realize, my kid really likes those Sonic slushies. They've got a $2 Sonic slushie and it cost them $8 to get it delivered. Whatever. But that's DoorDash for you. But you take these qualified tips and you report that on part 2 of your Schedule 1A. John, I know you do an amazing job. Now, again, I'm going to have to find some acronyms because we haven't heard your jingle in a couple episodes.
Oh man, we'll have to find a new suite of sound effects. Let's put it that way.
New board. Well, OB3, which is an acronym, made this no tax on tips, and yeah, so now you could deduct up to $25,000, but there's that phase out, and this form will reconcile that deduction for you. So it'll calculate your no tax on tips.
And one of the previous episodes we did not too long ago, just a couple weeks ago, was the no tax on tip one. And that one, again, we don't have to go into too much detail on it specifically, but if anybody's specific, if that applies to you really, or you're interested in it, go listen to that one because Chris, if you remember on that, we did a great job of really diving into how those phase outs work and what types of tips we should say, which is a surprise to most people, that actually applies to. right? So
Absolutely, and we're getting more guidance as time goes on. Yes. The second of 4 things Schedule 1A calculates no tax on overtime. So we're going to dive into that even more in a future podcast. Again, there's information on the YouTube channel to figure out first step, what is qualified overtime? And how is that reported on your W-2 or your 1099? Believe it or not, self-employed people, and this is going to be really funky how this works, that are compensated for overtime can still get the no tax on overtime deduction. Remember when we're talking about the no tax, that means no federal income tax. It doesn't mean you're exempt from payroll taxes or self-employment tax. So the no tax on overtime is also reported there. There's also a phase out for that. Now
of
that
course
phase
there
out
is.
similar to the no tax on tips, so at least there's a little conformity. But John, you could have someone, think about this. You could have someone easily be compensated with tips and overtime in the same year.
Right, and apparently, and I didn't know this until you literally just said it, so I'm interested to hear about this whenever we come across that, how somebody who's self-employed gets that. So in theory, you could be self-employed getting overtime and qualified. Talk about a complex, not a situation, but I think that as a whole, right, and specific to this form and other ones like it, I would almost say, and, not to speak for the masses here, but it I feel like now moving forward, if somebody doesn't have a tax professional, even if there's not somebody that does the returns for them, somebody they can consult with to make sure they're doing this right, maybe we're gonna get a little bit further away from the DIY platform. Who knows? Who knows how
Yeah, I
this is
mean
gonna go, right?
it's complicated. And so
Yeah.
you could have someone that is a server married to someone that works in manufacturing, and let's say they do assembly in a factory and they get paid overtime, or maybe they are a carpenter, and they get paid time and a half. So remember that overtime, the no tax on overtime it's only applicable to the overtime portion of your pay. So if you get paid $20 an hour and you made $30 an hour in overtime, you still owe tax on the $20. You just don't pay tax on the $10 of premium pay or overtime. We're going to get into that in a future podcast episode. So, um, but yeah. So it's interesting because when you hear no tax on overtime, wouldn't you originally think, oh, that means I don't pay any tax on any of my overtime income? True, but we've got only applicable to that overtime portion.
Right. And maybe what we'll have to do, Chris, and I mean, not to say we're going to do this, but maybe we think about this over the next couple months is, I don't want to throw you a curveball here because I've never asked you this, but, maybe we do something where we take each one of these forms, we put it out somewhere, on our social
Mhm.
media channels somewhere and just open it up to our community, right? And say like, hey, what confuses you the most out of these? And let's dive into some specifics based off of what we know, right? Because like you mentioned earlier too, we're still kind of early on in this OB3 rollout, if we want to call it that, where I feel like every week we're getting an IRS email or something from them that's trickling down into our inboxes, even that we're learning little bits and pieces tacked on top of something else, which
Yeah,
understandable.
there's no time that kind of to there are some DIY, opportunities, but I don't see that there's going to be there isn't a larger time for people to work with tax professionals. And I'm
Yeah.
saying that as part of the tax professional community to be very transparent. A private CPA practice, we only really work with 30 new clients a year. So I'm not sitting here trying to advocate for a bunch, and this, John, more tax returns. That's
Right.
a
Right.
very small amount of tax returns that we focus on the tax planning side. But there's going to
Love that.
be a lot of people that should talk to a tax professional and work with them.
And again, speaking for myself, right? And I feel like a lot of people would fall into this. I mean, me and you are working on something tax related every single day of the week. I mean, we call each
Mhm.
other, we're having, distant coffee shop conversations. So I probably know way more about this than the average taxpayer by osmosis. And this still confuses the heck out of me in some regards. So I can imagine if somebody, is self-employed or just went into it, they're trying to DIY things. I mean, it's over, and I would say it's over my head. There's a lot more to it a lot of components
There's a
that,
lot of components. Yeah.
it's confusing.
Well, speaking of components, let's talk about cars, right? The third
Oh,
of
I
the
like it.
three, no tax on car loan interest. So we have some content on that.
Mhm.
I think we did a podcast episode on this.
We did.
It's
We did. That
all
was a good
not,
one.
when you've done almost 160 of these episodes, it's like, um, so Schedule 1A is going to reconcile that. Of course, there's a phase out, and that phase out is different than your no tax on tips, no tax on overtime. But with the car loan interest deduction, remember, you have to have a qualified vehicle with qualified loan interest and a VIN number. But what's kind of cool about this is you might have a vehicle, John, that you have dual use it. You might use that vehicle for business and report it on your Schedule C. You might use that business to operate your rental property on Schedule E, or you might have a farm. So what's happening is, let's say, John, you have a vehicle that's 40% business use, 60% personal. You're deducting 40% of that interest on your Schedule C. Let's say you're self-employed. That additional 60% now, assuming you have qualified interest, is potentially deductible as in personal deduction. You can't double dip.
Mhm.
And that would be reported here on Schedule 1A. So the no tax on car interest is going to be reported there. Remember, make sure you have that VIN number ready, and the IRS will be checking that. That will get bounced because those VIN numbers are reported to the IRS. And when you try to electronically file that return, it'll get bounced if you don't have the proper VIN number.
Sure. And I'm sure somebody wanted to send me some spam email or some, you know, something in there. But I'm happy to see personally that they're asking for that VIN because they do have to verify things, but it also kind of creates a little bit of a trail on, you know, because we don't have to get into it, but there's the qualifications that we know that each vehicle has to meet in order to get this. So I think that will completely eliminate mostly any opportunity of things being, double recorded or anything. There's really no way to cheat that technically
Right.
because the VIN number is going to tell you where it was manufactured and all that good stuff. So listen to that
When,
podcast
yeah,
too.
it's basically the social security number for the vehicle. The fourth and final deduction on Schedule 1A is our enhanced deduction for seniors. So that's going to be people that are 65 years or older. Remember, that's up to $6,000 per senior. So up to $12,000 per year is an additional deduction. Now, this stemmed from during the election, during that election time, saying, well, Social Security shouldn't be taxed. Well, that was going to be very hard to get that passed. So this is a compromise. Of course, there's a phase out that's different than the other phase outs. But someone could, in all seriousness, someone could get all four of these deductions. Like, what if somebody is a senior citizen? According to the IRS, I think 65 is a new 55, right? They have an enhanced deduction of up to $6,000 per. They bought a new vehicle. One of them, maybe they work, I hate to say the Walmart greeter, but maybe they work at a retail store during the holidays and pick up overtime pretty easily. And the other spouse, what if the other spouse does what I thought I would do when I'm retired? They're an usher at Comerica Park for the Detroit Tigers, or maybe they're an usher at a concert theater or something where they get tips. It could very easily, you could have all four of these. Pretty crazy.
It is kind of wild to think about that, but it's not a far stretch, really. If you think about it, it's not. I mean,
Mhm.
that's very easy to do. It's not like you have to go out of your way to check all those boxes if you wanted to. But
It could be easily done. So we'll have to figure that out. But the opportunity with that enhanced deduction for seniors, I think we did some content on it as I was talking to you. This is a deduction that's going to be around for 25, 26, 27, 28. So for 4 years. So couples that are 65 or older could potentially, but there are phase outs, recognize $12,000 worth of additional income and pay no tax. So if proper planning is done, that's moving on $48,000 of income from maybe retirement accounts that was going to be taxable and now it's not taxable, or maybe it's a capital gain. So just be thinking about this. If you think about the demographics of the tipped people and overtime, it's typically going to be the younger taxpayers. Obviously, the enhanced deduction for seniors, anyone could buy a new vehicle, but this Schedule 1A spans many, many people. That's why I feel like there's going to be about at least 30 million of these filed, and your tax professional is going to work with you, or you're going to do it on your own. You're going to take the results of that Schedule 1A and put it on the new Form 1040. to wrap it up, remember, check with your state and local government on conformity for those deductions.
And Chris, I love the fact that you did kind of go full circle on it, which I plan on doing somehow at the end, and you did it for me, is that you started off with a very large number, right, into the millions of people that you're estimating on a conservative note that are likely to fill this out. But then you mentioned why, right? Because there's so much in there that applies to so many people. So let's do this actually. We're going to obviously post this podcast everywhere we normally do. I would say if anybody is confused on any of this or has anything to say about it, let's put all the comments on YouTube. We'll put the link directly to the YouTube channel in the show notes here. I might highlight a little bit more than usual, but put them on there. And let's see if we don't hear any comments, we know nobody's confused. And then we're going to check back at the end of 6 months when your head's about to explode, when this is happening, and we'll do it all over again. But thanks for joining us, everybody, on this one. Again, episode 160. We got a lot more coming down the pipeline. I did want to reiterate too, those resources, defeatingtaxes.com, private Facebook group, YouTube channel, subscribe to it. There's playlists if you did not know on the YouTube channel. Check those out. It breaks stuff down. We're constantly adding, constantly tweaking this out. All kinds of information on there. I don't think there's any area that we haven't touched in one way, shape, or form. And now with OB3, we're going to keep rolling in, doing revisions, doing add-ons to stuff as we get more information, as we started talking earlier. So check that stuff out. We'll see you again next week here on the Teaching Tax Flow podcast. Next week, different date, same day of the week, completely different topic. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.